Today, the question is the Fed pivot finally here? Is inflation cooling? The inflation numbers came out this morning, and they were about, I believe, 0.2% lower than what people had feared. And so that, combined with the fact that there are economists all over the place saying inflation is cooling, the leading indicators are cooling. You look at the prices all year, not all year, they spiked, commodity prices spiked January, February, March, April, crashing down, et cetera, et cetera. But until you see it, you don't know. But guess what? Maybe inflation is now rolled over, perhaps. That's great for stocks today, this day, and it's great for the country if true. I pray it's true because inflation is a killer. Now, it could be difficult for managed futures because they've made 20 to 30 some percent this year, depending upon the fund, betting on inflation, betting on the trends, interest rate trends, bond price trends, commodities, dollar trends. They've been betting on those inflationary trends all year to make that money. If it flips, that could be hard for them for a while, but all the markets flipped last month and they held up really well. Campbell made money in a very difficult environment for managed futures. So I guess we'll see at the end of today how they hold up. And I can tell you, in this type of market, I say monitor all your investments, preferably on a daily basis, to make sure nothing goes off the rails. Year to date, the Vanguard Target 2030 fund, which is 60% stocks, 40% bonds. When I last looked, it was 62.38, is down 19.18% for the year. Our tactical allocation portfolio is up 6.07. So I consider that a reasonable start. Tomorrow, well, first of all, will risk on? In other words, will stocks do great again tomorrow? Or will it last through the holidays? I have no idea. I'll never be able to figure out what the markets will do on a very short-term basis. What do we kind of know? Well, we know for sure that rate increases, interest rate increases, act with a lag time. They take from basically 9 to 18 months to filter through your economy. And they do exactly one thing in your economy, and that's pull it back. We know that. What we don't know is how many layoffs will we see with the 4% increase we've already had in rates. I remember not long ago, people were saying, real smart, mathematically advanced people looking at our economic market and debt situation, saying that at 4%, the whole thing just would blow up, namely our economic debt bubble. We'll see. But we've already started to see big layoffs in technology. And we're starting to hear a lot of negative things from a lot of CEOs. The next slide is, are we living through November of the year 2020? In that year, the large tech stocks had seen their prices crash throughout the year, throughout 2020. Look at what ours have done. Amazon, -48. Facebook, -70. Tesla, -50. Google, -40. Number two, the stock market downturn in 2000 was led by semiconductor stocks. Look at ours, Intel, -44. Applied Materials, -40. NVIDIA, -53. Number three, the Dow Jones Industrial Average actually held up in the year 2000. Well, it hasn't exactly held up this year, but it's only down through an hour ago, 7.87% year to date. Number 4, trouble was brewing in the debt markets. This does seem to be the topic that is taboo to talk about in the financial media, except, Wall Street Journal, Financial Times, the more scholarly, I don't know how to put it, but those publications are talking about it. The Fed is also talking about it. The Fed put out a report on financial instability this week. And definitely, if you read that, you would say trouble may be brewing in the debt markets. They're worried about it all over the place. From leveraged loans, which is a huge worry, to off-balance sheet debt, big debt. And then the last similarity between November of this year and November of the year 2000, the country would soon be in recession. Now, we can talk about that more later if we wish, but those are some pretty big similarities. What happened after 2000? Well, the S&P 500 proceeded to go down 55%. Tech stocks proceeded to double their losses, with the biggest tech companies like Cisco and Intel and Microsoft and Hewlett-Packard, etc., most of them down 90% or more at the bottom, which is why I believe we've now gone through the first leg of this bear market. What is a recession? I'm going to go through this quickly, but it's really important because most people have no idea what it is. We know the shorthand and technical definitions, which simply say recessions are a contraction in your economy. But the real answer of what happens in a recession is a recession occurs when there's a mismatch between what your economy is producing and what your consumers, including business consumers, need and can afford to buy. So there's this, the economy isn't functioning right because of this mismatch. It typically happens when so much money is pumped into the economy that it ends up going in willy-nilly, and it distorts everything. The severity of a recession is therefore commensurate with how far you are away. What's the distance between current production and what the people can afford to buy and need? Well, number 3, 4, people look ahead, which is why recessions typically begin 9 months before they're broadly recognized. People stop spending when they either feel financial pressure themselves or when they start to see other people laid off. That last part gives you an idea as to how it then spirals down. You start to see other people experiencing difficulty, you pull back. When you pull back, it leads to more economic contraction, etc. Everything then spirals down until, and I say, let us pray, the rot in the financial system known as embedded losses are all realized. That is called bad debt. It gets cleared out in a normal recession, which means your economy is now comprised afterwards of the most productive, prudent companies. And that also opens up the field for new and even more productive companies to emerge. You can then reorganize the economy to better meet the needs of your consumers, and then you can grow again. So I'm sorry for all those words, but I want to send this out to people because that's what a recession is. If you can calculate the distance between what we're currently producing and what the people, the consumers need and want and can afford to pay for, you'll know how severe the next recession will be. I really don't know the calculations on it, but the final question. That's it. How large is the current mismatch in our economy between what people need and can afford to buy and what we're producing? Now, all day long on financial television, they're saying the economy's just fine. They don't even think there's any distance to cover between what's going on in the business world and what's going on, in the production side and what's going on the consumer side. There's nothing special, nothing to see here, folks. I believe there's a great and growing distance between those two. Consumers are in deep trouble. 60% of them flat out cannot afford anything more. Okay, real income went down 2.8% year over year again and again and again. What that means is that every single month, the people have less money, can buy less stuff. It's real simple. That's why real income is considered one of those core economic things. I mean, that one phrase alone can define how your economy is doing. It hardly ever goes down. It only goes down in a depression when you have dropping it, when everything drops, or when you have inflation. It's the worst scenario because you can't, it puts more and more people in poverty every single month. Every single month, your middle class shrinks because more and more people cannot afford that next bill because their incomes are shrinking every month. That's what's been going on for over a year now. And it is very difficult to stop without correcting the other imbalances in the economy. On the other hand, on television, they've been conditioning us to believe the Fed and Congress will bail us out of the multi-trillion-dollar losses coming if my shorthand analysis here turns out to be correct. And that is called moral hazard on multi-trillion-dollar steroids. When all your markets are conditioned to believe that no risk can really hit because of your central bank, I mean, that's the biggest moral hazard I've ever heard of in my life. And it makes it so inflation and the Fed can pull the rug out from under everything. And even if they don't, there's never been a time in history when moral hazard, when it got big, didn't lead to calamity. And so with that very upbeat ending, actually, I do want to end up with an upbeat ending. The upbeat ending was in the recession part. If you study that, then the bad debt is cleared out, which now means your economy is comprised of the most productive, prudent companies. If we have a proper recession, all the companies that can only exist because of zero interest rates, all those companies will go away. And when they do, it'll just leave the companies doing the best job providing things consumers have decided, yeah, in tough times, we can afford to buy, we got to buy that. That will then open up the economy, open the field of the entire capitalist economy for new things to arise, new companies. Our entrepreneurship has been destroyed. If you look at the numbers of new companies for the first time ever, and it's probably gone on for several years now, more companies have quit than have started. That's got to reverse, and it will, just through the recession that is coming. So I say embrace it, not only because I expect it to be great for our investments, but because our economy actually needs it.